Well, hello everyone. Welcome to a fresh new week in the markets and welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Charles Schwab and delighted that you guys are here to join me where we link arms together every Monday and Friday for this class. I also treat the trading price patterns on Wednesdays at 1 o'clock Eastern as a companion to this class. So it's 3 times a week. That we are linking arms together. And somebody's asked if I've had too much coffee, and I am still working on my coffee. I don't drink a coffee every day, but man, we've got a lot of cool stuff to discuss today. We have an iron condor in play. We're going to do a little bit of trade management on that. We're going to have a quick look at our short put verticals. And then the rest of the class, we're going to get a little vertical, to quote a line from SpongeBob SquarePants, which is a children's show. But we're going to talk verticals today, bullish verticals, namely short put verticals and long call verticals. And so if you want to get a little vertical with us, stick around because we've got lots of example trades that we would like to add to our portfolio today. So I want to thank Ben Watson for joining us. He is riding shotgun in the chat. If you are not following Ben, you are missing out in the world of X. His handle is at Ben Watson CS. Mine is at Barb Armstrong CS. And we're both posting content there on the daily that we think you will find helpful and informative. Just before we get into, the throes of our vertical life, know that options carry a high level of risk and aren't suitable for all investors. Also, you have to apply for option trading privileges. So if you've been busy practicing in your paper money for a while and, all our example trades go into our, paper money portfolio on the Thinkorswim desktop platform, just know that if you go to place a live account and it doesn't go in, you might say, whoopsie, I didn't get approval to trade options, and then you'll have to go through that process. Also know that although paper money is brilliant, there are a few nuances and differences. One is that short positions will never be assigned early in paper money, and that can happen in a live account. Sorry, just a sec. I thought I had this secure. Just let me fiddle with this. Okay. So that is that. And, at the market open, Kevin Horner, and today Brett Crowther was with him, did a great market overview. I'm not going to spend long on that because they do such a great job in the morning. So if you want details on that, most mornings at the market open at 9:30 Eastern, Kevin Horner, Trading Places, you'll want to check that out. And then on Wednesdays, Mike Fairborn does a great sector and market analysis class. And, I like to save our time for managing our existing trades and placing new example trades. So I have a couple of quick reminders or announcements I want to make, but I'll do that kind of throughout the class. Let's get out to the platform. Okay, so here's our S&P 500. And, after hitting kind of the depths of despair for those of us that are more bullish in nature, when the market was in correction territory, well, actually in bear market territory, down over 20%, both the S&P and the NASDAQ, we've had this incredible rally. And we're not back up to our February 19th highs, but, we've come a long way, baby. And even though we opened down today, it's rallied and, we're within a hair's breadth of being positive for the day. But that's where we're sitting on the S&P 500. We're just a smidge, like less than 1%, up on the year. But, we've come a long way from where we were. When we look at the NASDAQ, kind of more of the same, right? We're down more like 23%, have come a long way back, opened down today and seem to be rallying. And this is a live candle. Who knows where we'll be at the end of the day, but we're back above that 200-day moving average. On the Russell, which is our small caps, we still haven't, we still have a little bit to go to get to that 200-day moving average, but, similar charts all around, right? We can get rid of some of these. Similar charts, like, hit a low, working its way back up. And then the Dow, this one has been a little more muted because of UNH. And UNH really got hammer smashed and had a bit of an impact. But, again, a similar type of pattern here on the Dow. Sorry, I'm having trouble with this earpiece today. There we go. Okay. And then last but not least, our VIX. We're back under 20. And I wasn't sure we were going to see that for a while. So, hey, not bad. So there we go. So there's our volatility index back under 20 after, such high volatility, the kind of volatility we hadn't seen much of in the last year. Okay. So let's come and look at our monitor tab. Let's start with a little trade management. And if you have a weekly routine, and if not, my question is why not? Because if you're treating your trading like a business, you want to have a routine. And kind of one of my routines was every Monday, I would make sure I looked at every single position in my portfolio. Now, your routine can be whatever you want. But we looked at a lot of our portfolio, our example portfolio in this trading a smaller account last Friday. So we did have an iron condor. We still do have an iron condor on McDonald's. And let's come and look at it on the chart because it's a little bit underwater, although it seems to be coming back today. But when we look at Mickey D's, we put this trade on here. It was kind of in the middle. And ironically, the put side contributed more to our credit than the call side did. And now it's the call side that's hurting. But do we have an opportunity to maybe close out the put side with it being, up at the top of this range? So when we come and we look at this, if we do the math, we got into this, it was 211 minus 134. So we got into this for, 77 cents. We got a 77-cent credit. And when I looked at this the last time, it was 10 cents for us to close it out, which means if we paid, and now it's, 41 and 27. So, if we look at this, 41 minus 27 is about 14 cents instead of 10. But if I grab my calculator and say, 14 divided by 77, that's 82% of our max gain. So maybe we'd like to take that. We'd like to take that gain. Okay. So what we would do is we'd come out to our working orders. And for our iron condor on McDonald's, we're going to close our exit because we wanted to get out when we had 80% of our max gain. So we're just going to cancel that all together. And now you'll see McDonald's has gone, our exit. And then we're going to come in here and right click and create a closing order. And you've got all kinds of choices here. And what we want to do is just buy this vertical back. And it's saying it's now worth 15 cents. Well, let's see if we can get out for 13. Like earlier today, it was 10. So let's see if we can get out for 13 cents. Hit confirm and send. And so we're just closing out the put side. Now, when I first started trading, and look at that, we got out. So when I first started trading back in 2011, I went to something called a market drive. And someone said to me, you have to be careful with these iron condors, Barb. And is there anyone here that isn't familiar with an iron condor? If you are, don't be shy. Just, raise your hand, just type something into the chat. Because what this iron condor is basically two credit spreads. Well, let me move this over to another screen. But the idea here is that we've got a short call vertical at the top, and we've got a short put vertical at the bottom. And as long as it stays in between, we're happy campers, right? And somebody said to me, well, you've got to be careful because you can lose twice on an iron condor. And so what happened is this happened. They got in here, somewhere like here, and then it came up here and they saw that it was pushing against their short call vertical side of the trade. And so they got nervous and they decided to exit and they exited for a loss. And then what do you know? It came down here and they got nervous again. And so they signed out, they got out of this side for a loss. And that's exactly the opposite of what you want to do. So what you want to do is when it comes up here, you know, if you have the expectation that this is going to hold, close out this side for a profit. And then you're a happy camper. And then if and when it comes back down, you can close out this side for a profit also. Yeah, and when we get out of an iron condor this way, we call it legging out. So we're trying to take advantage of the fact that this is up near the top and that, you know, this is worth less. Yeah, and Wiley's saying you can also gain twice. Yeah, so make sure you don't make this mistake. Because trust me, that is a mistake. Yeah, so I just thought I'd throw a little humor into our morning, right? Okay, so that was Mickey D's. Let's go now and look at something. This is a stock we haven't looked at a whole lot. And so when we look at Vertiv Holdings, what do you guys see? You know, because, you know, part of this class is playing I Spy with my little eye. And kind of the first thing I noticed when I looked at this was we had kind of, and it's a little bit, you know, imperfect, as, you know, there aren't very many perfect things out there in the world. But, you know, when I look at this, I kind of see a bit of this inverted head and shoulders-y type pattern. Do you see that? You know, and it's gone from kind of 53, geez, up to 96. Like, that's a pretty big range, right? About 43. So, you know, if someone wanted to put a target on it, they could say, well, I'm going to make my target 96 plus 43. You know, and we did have a previous high over here of 156. Or like, you know, we're smaller. We are smaller, a smaller account. You know, we've got almost 23,000. So to buy a call might not be in our snack bracket, but could we do either a short put vertical, you know, where our strikes are down here, maybe under 95? We may not be able to get there. You know, we may not be able to get there. But if we look at where was a recent low, it might be around that 100. So maybe we could do a short put vertical at 100. You know, and could we do a long call vertical and say, hey, even if it just comes back up around this 110, could we make a little? So let's go to the trade tab and just see, does this trade more than 1 million shares a day on average? Well, we're at 2 million already and we're early in the day, so that's a resounding yes. Then when we look at the options, if we come out to the monthlies, and you'll notice we have over 5,000 contracts and then a bunch of zeros on the open interest. Well, why is that? It's because until Friday's close, these options weren't available. And so, but now that they're available, when we look at them, the bid-ask spread is 15 cents. So what that tells me is that the market maker's expectation is that these will be traded. And so if we look at the put side first, we wanted to be kind of below that 100 mark. And if we come out 25 days, well, we've got 29 contracts, so we're okay there. We've got a 15-cent bid-ask spread, so we're okay there. We have a 37% probability of it being in the money, so that means we have a 60% probability, 63% probability of it expiring worthless. So the next question is, can we get enough premium for it to be worth our while? Like, wow, on a $1 wide strike, we get 35 cents. Like, that's almost like a 50%. Well, let's see. Let's switch this to a calculator. So let's make it $2 wide. And let's see if we get kind of double the premium. we get 64, not 70. But, you know, if we said 35 divided by 65, like that's a 53% return for a trade we'd be in for 25 days. You know, that's not too bad. Or if we say 64 divided by, and it's $2 minus 64, so that's $1.36. 64 divided by $1.36, that's 47%. That's, you know, not too shabby. I mean, we want it to be at least 25%. So let's look at where this 100 is on the chart. So if I take this 96 and let's move it up to 100, just to see the line. Are we okay with that? You know, when we look at that, do we think, well, you know, when we start looking at technical analysis and candlesticks, we'd say the bottom of today's candlestick might be considered a resistance level. The 200-day moving average might act as a resistance level. This 10-day moving average has also been acting as a resistance level. So it would have to go below those 3 resistance levels. So, you know, think, okay, well, that looks okay then. So how much are we willing to risk? Up to $500. So we could do how many of these? If we did 3, how much are we risking? $405. So we'd be okay there. So we're going to come back. We're going to take our single order, make that a first trigger sequence. We're going to right click, create an opposite order, and say, hey, when this is worth about 13 cents, now our example trading plan is that we want to exit the position when we've got 80% of our max gain. Now, you know, is it do or die? We stay in for 80% or we take the loss? Not necessarily. So we're going to put this in our short per vertical group. Okay, fire in the hole. So what we do with these short put verticals, and now if we come in, this is the second thing I wanted to have a quick peek at. When we look at, oh, those are our buy rights. When we look at our short put vertical trades, we have got 4 other trades on, and we just added VRT. Oh, look at that. It's telling us we're already up 14%. Well, that's nice. We could go out and buy ourselves a paper money lunch. Might be a little chewy, but you know, we're up 71% on Visa, and we're up 67% on Honeywell. So do we want to take the money? Now, if I saw a negative number here, I'd be more tempted to spend more time on it, but we could come really quickly and say, well, you know, should we take the money and run? Well, we got into it here when it crossed this previous resistance line. And so it seems to be just chugging along. We don't have a sign that this uptrend is yet over. And so we might just give it another day and let time decay continue to work in our favor. How about Honeywell? Same thing. But if we had a doji pattern or a candle pattern that indicated that this uptrend might be coming to a close, could we take that money, choose to exit? Absolutely. Now, there was a question in the chat that said, can you comment on when you give up on the call side if it continues going up? And I really like that question, Kevin. So let's come back to McDonald's for just a sec. So now, have we seen it come up and test this resistance level before? Well, of course, otherwise we wouldn't have placed this trade. And I keep forgetting to shake the Etch-a-Sketch. So we saw it come up, you know, here, really big candle on that day, right? And then, you know, it came up again here, again, a big candle. And then, you know, we had like 5 or 6 up days in a row. So it came up into the neighborhood and then here, and then here, and then here. So it's here again. Now, when might we give up the ghost? Well, we might say, you know what, this is not working, especially if it breaks above. If it comes back to retest and bounces, yuck. That's telling me now that this ceiling or resistance level is now acting as a floor. And then I say, you got to take your lumps and choose, then you would choose to exit. But it's come up, this is something we've seen before. And so we just have to be patient and know that we've position size correctly. In fact, when I was just looking at this, let me just get rid of my drawing tool. We actually were on the light side position sizing on McDonald's because, let me see, what's our spread here? Well, no, it's a $5 wide spread. And, we got paid, even if we got paid $2 to get in, we were risking $3. So we did position size correctly. Okay. So I hope that answers your question. Yeah. Riceberg, yeah, is saying, that it's base hits, help us bring home the bacon. Yeah, you're making me hungry. Okay, so that's VRT. So we put a short put vertical on VRT. Now, if we wanted, could we do, you could say, well, why are you doing that and not doing a long call vertical? Well, we could do both and then compare them. And what we've done in the past, if you look at our example trading plan, and I'll show you where you can find those, but in the past, what we've done is had a 50% target on our verticals, on our long call verticals, and 80% of max gain on the short put verticals. So we didn't change the 80% on the short put verticals, but for the last kind of week and a half, we've said, hey, what if we just went for a 25% gain on those verticals instead of a 50% gain? And let's just see how that kind of plays out. So it's at 105. So let's come to, if we come to this same June, it's at 105. Could we do, well, this is 65 cents. Like that's just barely acceptable. But this is only 15 cents here. That's interesting. 715 to 770. So, well, let's look at this. Buying a vertical at 105 and 106. The debit's only 45 cents on that, and we're only, 29 cents away from our max gain. And so, like, what if we did the 105, 107? It's kind of similar, like, we could make more than 100% would be our max gain. We're risking 95 to potentially make 105. Well, we're saying if we had a 25% return, if we got out when this was $1.25, we'd be okay. And our break even on this is like, 25 cents away. It has to go up by 25 cents in the next 25 days. And this stock in an average day, can move, well, the average amount this has moved from top to bottom over the last 14 trading days is $5.23. So that's not a terribly big move if this support level holds. One would expect, it was at 109, almost 110, 3 trading days ago. So if we say, okay, we're okay to do this 105, 107, how much could we lose? All of it. So how many of these could we do? We could do 5. And we're going to go with our more modest 25% target. So if I take 93 and multiply it by 1.25, we'd want to get out at 116. And so we're going to come to right click, opposite order. Actually, we'll make it 120. So if I take 95 times 1.25, it's saying 119. So I'm going to make that 120. 120. Good till canceled. We're doing 5. How much could we lose? $490. Now the plan is if it goes down by 25%, we would exit. But we're putting in the target to get out at 25%. And why are we doing that? It's because sometimes when the market opens, we can have a lot of craziness volatility wise, and the prices can fluctuate a lot. And if we get nicked out for a gain, we're cool with that. But in my live account, I've sometimes been nicked out for a way bigger loss than I was happy with. And by the time half an hour into the market happened, the market had settled down and I wouldn't have been stopped out at all. So I'm kind of trying to give you some real life examples, or real life ways one might handle these things. Okay, so there's our 5 there. Okay, so that's VRT, and we've got both a short put vertical and a long call vertical, and we're going to compare and contrast those. Let's go over to the airlines. I have been delighted not to be on a plane for the last 3 weeks, and Mr. Ben Watson in the chat's probably chuckling, because he and I have both flown a lot this year. He's flown at least as much as I have, and is going to fly more than I am in the second half, because we're doing a bunch of live events. But when we come and we look at Delta, what do we see, when we look at this chart? Well, we see something that kind of like the rest of the market came down and bottomed. I saw a bit of a panic pattern setting up here, and then it's broken out. And now what do we see? Do you see what I see? And if you're not seeing what I'm seeing, I teach Getting Started with Technical Analysis on Tuesdays. I encourage you to come and check that out. I see a bull flag and then another bull flag. And with a bull flag, what are we looking for? We're looking for a close above the high of the low day. Do we have that? We do. We got that on Friday, actually. It was also on Friday, a bearish engulfing pattern, or a bullish engulfing pattern, pardon me, in that we had this pullback and then you had a candle. So the body of this candle totally engulfed the body of the previous day's candle. And that is considered a bullish configuration that actually does not require confirmation, but the stock has gone up again today. So could we kind of do this same thing here? Could we look at, maybe around this 50 level? I'm having trouble with my line. So, if you're having trouble with where your line is snapping to, if we say, would we be okay with the 50? And if you're saying, yeah, that's a little tight, maybe could we sell the 49? Does this have dollar-wide strikes if we wanted to do a short put vertical? And if we did that, would we get enough premium? So if we look at this 49, we have a 3-cent bid-ask spread if we're going out 3 weeks. Now you might say, well, why not come out 4 weeks? Well, we could, and let's see the difference in premium, because we have a 49 and a 48 strike. So, and the bid-ask spread is tight on both of them. Whoops, I didn't want to do a calendar. 49. So why am I looking at weeklies? Because they do have less liquidity. Well, because and why am I interested in this 25-day if we're looking in the 20 to 50-day range? Because, if I'm looking at 3 weeks to expiration, and this is a 31 credit divided by, we're risking $69 to place that, that's a 45% potential return. Well, what if we went out to 47? So it's 2 strikes wide. And this is, are we going to get double? So it's double the risk. Are we getting double the credit? Not quite. We're $6 off getting double the credit. Now, what if, but let's say, that's still acceptable because we're out 25 days. Now, what if we come out to June instead? So we're in it instead of 3 weeks, we're, 25 days. We're now 32 days. We're out 7 days longer. Let's come to June and make it June 20th. Am I going to get appreciably more credit? I'm getting 2 cents. And I'm in it for another whole week. Like that's a third longer. So I'm in it 30% longer. And the advantage of the shorter time frame is that time decay is going to work more in my favor. The problem, because there's no free lunch, right? What's the downside is that if the trade goes against us, there's less time to recover. But if we say, we look at the trend, we look at the current support level, we're okay with that. So, and how much are we risking? $1.50, $1.44 a contract. So how many could we do? If we did 3, are we risking less than 500? 432. Is that under 500? Yep. So we're cool with that. First trigger sequence, right click. When are we going to buy it back? When it's worth 11 cents. Now you may say, I don't know why she does this 80% thing. Like I'd be happy with 50. Some people might say, I want 90. Some people may want to let it expire worthless. But if it expires between the strikes, then you're at expiration, then you're at risk of potentially losing more than your theoretical max loss. And, if you don't want to be in that spot, then you close it out prior to expiration and you're willing to pay the nickel. Now, so here's our max loss, 432, max gain, 168. We're willing, if we can make about 140 on that, we'd be happy campers. So we're going to put this base hit. You may say, that's not going to have me drinking anything, fancy out of a coconut in Tahiti. No, but that will put a lot of gas in a vehicle if you were looking to generate a lot of income. But, that's 3 tanks of gas for me. Okay, so there's Delta. Now, I want to show you a couple of things. So one of them, we're going to come, is the Trader Talks from Schwab Coaching. So if you have not already hit that button in the bottom right corner to subscribe and you aren't already subscribed, I encourage you to do that. Because when you get to this channel, it will show you what is currently being broadcast. And then if you come to playlists, I have created something that I would have liked to have when I was a student, because I started in this industry as a client. So I'm doing all these little mini sessions on different candle patterns. I added 2 last week. So if you haven't checked those out, I encourage you to do so. And then these example trading plans. So if you've never traded a long call vertical, I was talking about this 50% target or, and changing that to a 25% target. This is an example trading plan that you can come in and modify, use it as a basis to create your own trading plan. And then here's one on short put verticals. And, I'm going to continue to add to these. Now, last week in this class, we did a survey because we've done a lot of trades on Goldman Sachs. And somebody asked, can you do the math? Like, how did all that work out? So I did the math and 98% of you said, yes, please do a mini on that. You'll see that in this section at the top of this section. So look for something added to the Tangerine collection, probably by the end of the day today. So that's that. The other thing that I wanted to show you is if you come to, and I'm going to bring up just a new thing here, especially since we have the fabulous Ben Watson in the chat with us today. So if you come to Schwab Coaching, and anyone can do this. Somebody's asking for my thoughts on Monster. Lulu, you were reading my mind because, Monster's our next example. So MSTR. So if you come to in-person events, and when I was joking about, being happy to be home for a few weeks, and it has been lovely. I've had a lot of company, but I'm on a plane after the long weekend on that Thursday to do this advanced option strategies with Mr. Ben Watson. Now, he is going to be the star on the stage, and I am going to be, sidekick, lurking at the back of the room. But it's a great, I love having the opportunity, as does Ben, to get to meet with you guys one-on-one. You know, this is how I got introduced to the world of trading. And I would get on a plane and fly to Washington. I was living in Michigan at the time. I drive to Chicago. I flew to Sandy, Utah. I flew to Salt Lake City and ended up with a job out of it. You know, I became a coach in 2016, but these are great. So we've got this advanced options coming up. And then the first two market drives of the year, one in Miami in June. And then I will be with Ben. Ben's going to be at every one all year pretty much, but and good for him. And make sure you thank him when you see him. That's like 20 some weekends that he's away from his family and his community and everything to help bring these to you. But these market drives, if you've never been to one, they start, you know, big picture with what's going on globally in the financial markets. And then from a US perspective, what's happening with tariffs and what's happening with our markets here. And then it comes down to how is that impacting the sectors. And then they'll show you some examples on specific stocks and how you might approach investing or trading those from, you know, an example perspective. So it's big picture down to specifics. And they're fantastic. And, you know, we'll provide breakfast and lunch. They're free to attend. Yeah, they're great events. And Ben Watson, he has a brilliance for being able to take complex topics and make them very understandable. And then if you're new to all of these, if you haven't come to the live webcast, if you're saying, well, hey, what does Ben teach when he's here? You can come to Coaches and pick Ben, and you'll see the classes he teaches when he's in town. Check out his trading index options. He's doing some fascinating stuff in that class. Okay. So, and I teach every day. Somebody said in one of the surveys, I wish you taught more often. Well, I do teach every single day. So, you know, that's pretty frequently. Yeah. Yeah. Ron is saying, I love the market drives and the food is good too. Yeah. Like we pull out all the stops, baby. You know, so, okay. So now back to our regular programming. Yeah, let's look at MSTR, MicroStrategy. I'm sorry, I misspoke. I called it Monster. It's MicroStrategy. So, you know, we're seeing this pattern. You know, I was jokingly saying last week, this is what all the cool kids are doing. You know, we're seeing a lot of diagonal resistance breakouts, which is no big surprise given the index we looked at. Like every one of them have had a diagonal resistance breakout, and MicroStrategy's, you know, no exception. And you know, Miss Line Drawer here, you know, we had a double bottom. Also, it broke out above that, you know, and that's a pretty big channel. And then it breaks out, retest. You know, now we've got kind of a bull flag. And then, you know, when you really hone in here, you know, we had this Harami pattern on Friday. Also, this candle pattern is an example, you know, of something establishing a new support level. And then today, this is a bullish engulfing. And so could we look at that and say, hey, could we come down to maybe this, you know, maybe 385-ish level? What was the low on this day? 389. So I don't know, this is an expensive stock. Like, I don't know if we could, if it has $5 wide options, they might just be 10s, but let's come look. Are they heavily traded? Well, 6 million shares today. And this is kind of our checklist. If you go to that example trading plan, oh, does it trade more than 1 million shares a day? Yep. Do we have at least 20 times the number of contracts in open interest and or volume? Yep. Do we have a tight bid-ask spread, tight defined as less than 10%? Yep. And what did we say we were looking at? Could we get down to 385 and get enough premium? And then our premium, if we're in it for 25 days, we want at least a 25% return on our risk. So we've got a 40-cent bid-ask spread on a $16 option, so we're good there. This is saying a 38% probability of it going against us. That means a 62% chance of it expiring worthless. And this is based on a complex mathematical algorithm. It doesn't necessarily take support and resistance into account. That's where our expertise kind of comes into play. So if we get $1.75 for that, then how much are we risking? $3.25. So you get good at subtracting, so if we're taking $5 and subtracting, say, call it $1.70. So if we get $1.75 and we're dividing that by $3.25, that's got to be like 50%, 53%. So we have a couple of choices. We could say, well, do we want to put our short put vertical below that? We could maybe move the strikes, or do we say, hey, this is bouncing, I see this as holding and I'm okay with that. So if we're risking over $3, though, how many of these can we do? One. Are we, breaking our position sizing rules? No, we're not. And there are some rules that we, my son said to me once, because he wanted to marry 2 of the kids in his class. He was 4. And I said, you have to pick one, Connor. You can't marry them both. And he said, is that a rule or a guideline? So when we have an example trading plan, we have some rules, and position sizing is kind of one of our rules, and we can reevaluate that on a quarterly basis. As if your account grows, are you willing to, risk more per trade? Perhaps you can change that number. But once you've established it, then you don't break that rule. You don't say, oh, but this is such a sure thing. If you say such a sure thing, be afraid, be very afraid. But that's a rule we don't break. Our position sizing rules, we're not going to risk $650 when our max position size is 500. But if our target is 80%, and that's in our example trading plan, and we're at 75, and it looks like the tide is changing, or if we're up 50% in 2 days and we were willing to be in it for 25, might we take the money and run? Absolutely. Yeah, so here we go. Yeah, that was a long time ago. So 35, confirm and send. How much are we risking? $335. Is that less than 500? Yep. So we're coming to our short put vertical. And so, in this Get a Little Vertical class, I thought we could also, compare, doing long call verticals as well. And so we're going to do a post-mortem once we're out of these trades. And so we're at 411. Could we come and maybe do the 410, 415? We've got lots of volume. We've got a tight bid-ask spread, or tight enough. It's under 10%. So if this costs us $240 and our goal currently is a 25% gain, that would say, hey, when it's worth $3, we want to exit. So we're going to come and put in our first. So are we leaving $2 on the table? Yeah, because we could make more. But we're saying, hey, a 25% return in 3 weeks, we're calling that good enough. So our target would be 3. I don't know. Making that good till cancel, confirm and send. And we're coming to our long call vertical. And then we'll compare these when we're out. And we might be comparing losses, and hopefully we'll be comparing gains. So I'm going to put a note in here, compare to short put vertical. So guys, our time is up. But what I wanted to reiterate, there are some other things you may want to look at. And we were going to look at United Airlines. We looked at Delta. Goldman Sachs is the one I did the trade management mini session on. So it's pulling back today. So we may look at that one again on Wednesday. And then MasterCard, we might want to look at that one as well. But we only have 45 minutes. We don't have all day. I am teaching the buy or the covered call and short put class for Cameron. at 2:00 Eastern today. So if you'd like to join me for that, would love to see you there. So what did we do today? We opened up, we did a short put vertical on Delta. We took part of, hopefully, we closed out the put side for a gain of our iron condor. And then we did a long call vertical and a short put vertical on MSTR. And we did the same thing on VRT. So there is a survey in the chat. My ask is that you fill that out. 2 questions. 1, I hated it. 10, I loved it. And then there's everything in between. There's also an ability to put comments in. So my promise to you is if you fill it out, I promise to read each and every comment. So thank you in advance for that. Hit the like button. It helps more people find this content by moving this up in the YouTube algorithms. It also lets Ben and I know you found this helpful. And yeah, thanks to Ben. Thanks to the guys behind the scenes for helping bring this workshop to life. And thanks to all of you for showing up. Up next is James Boyd. Stay tuned.